Hey everyone, John Henry here, Slingshot Futures Trading Group. Thanks for joining me in today's video. Before we start, take a second to give the video a like, subscribe to the channel, and make sure to click the notification bell icon so you don't miss our next live stream or next video launch here on YouTube every day. Make sure you start your day off the right way. Don't forget your free morning brief that's waiting for you at ssftg.com/brief. In the top left, you can click on morning brief to jump into that. That's where you'll find all of our major DP levels right up here at the top, as well as a quick technical overview for the major 6 markets that we look at: the NASDAQ, the S&P, you've got gold, crude oil, the euro, as well as Bitcoin. Maybe you're looking to get a full game plan for the day, week, or month. Check out the join button below. Level 1 subs get a brand new members only video every single morning going over the major 6 markets and a game plan for the day. In addition to that, once a week I launch a weekly brief, and of course once a month we have our monthly brief as well. Of course, all members gain access to our private Discord chat server, and if you really want to get into the nitty-gritty, check out the live analysis room for level 2 subs, where you can see my screens in real time during the New York Stock Exchange Open. You can ask questions and interact with the other members, as well as bounce ideas off myself and everyone else. It's a fantastic environment, and I would love to see you in there. All right, and now on to the really fun stuff, the topic for today. How to correctly measure risk. This is something that a lot of people don't necessarily do correctly. So one of the things that we have to take in mind is probability. And when I'm talking about probability, I'm talking about the ability to get into a trade and out of a trade without it running into some kind of brick wall in the way. And that's where a lot of people will fall flat. So as an example here, we have a nice continuation move to the upside. It's a full failure for an L1, and I'm looking for a continuation back to the upside. But on this move, it's kind of questionable as to where the stop is supposed to go. So it really comes down to the type of trade that you're looking to take this as. For me, I like this if it pulls back for a continuation move to the upside. But if I'm going to be aggressively buying way up here as an example, well, my target is still back to the highs. That's the objective initially. Well, realistically, I'm looking at this potentially pulling all the way back down here. So it wouldn't make a whole lot of sense for me to take a trade here with a stop underneath this for a target like this, right? That would be a very high probability trade, and I've got a good chance of winning, but I'm not a big fan of the way that the reward versus risk is stacking up for this kind of trade. I'm looking to take a reversal. Reversals aren't a high probability. So trying to take a high probability setup is like trying to fit a square peg into a round hole. It doesn't fit here. So instead, what we have to do is approach this utilizing the risk tool, very handy tool on NinjaTrader, the risk reward. For me, it's Control F4. But if I go in here, I'll place my entry and I'll put where I want my stop. So if I'm putting my stop down here, by default, just so you know, mine is automatically 2-to-1. Well, obviously, it's way up here, which, you know, that would be fantastic. But let's be real here. Is the NASDAQ going to be ripping up 1,400 points in the next little bit? Maybe, but chances are not very good. So what I would rather do is see if I can find an entry that brings my average to a point where my target is now within an understandable range. Understandable range, we've got resistance over here and resistance forming here. So as long as I can get my target inside of this, that's a very optimal location to be looking for longs. So if I can find my entry somewhere inside of, let's go into here. That's about the zone of risk. And if I can get it as low as possible into that zone. So this would be what you would consider optimal entry. Optimal entry would be down here because that allows me to put my stop where I want to put my stop and put a target ahead of resistance. Taking it this way does mean I run the risk of missing the trade. That's just part of the deal, right? If I'm trying to get something extra out of the market, there's a trade-off. The trade-off happens that, well, I might not get the trade at all. So that's kind of the context that you have to approach this in. If the market's going to pull back and I want to be a buyer,
and my likely objective is at the highs, it doesn't make sense to be a buyer here. It just doesn't fit. We need to make sure that the risk reward and the probability are in line with one another, so I've got the best odds of success that I can try to get on the trade. And if that means that I miss the trade, so be it. Here would be a really good example on the S&P where we have a very nice L4 setup coming in. But if I wanted to be a buyer on the L4, even at a 3-press wedge bottom, there's a few things that I've got to really keep in mind in terms of my risk reward. If I'm buying right at the top of the zone, my stop still is going to go underneath the lows, which means that my target is above the highs. On the S&P, that doesn't fly, right? That's not going to work. The S&P, it's got to trade through it unless you're lucky enough to get it to the tick fill. So because the way that this is structured just doesn't really give us a whole lot to work with, our entry point doesn't make sense being anywhere near 1975. We've got to start working our way lower and seeing what we can get in. So here is an example. The best case, the beginning of the best case entry point is 19.25. As long as we can get our entry in that zone, then the target is ahead of the highs. I don't like forcing the S&P to go through high closes and opens. So for me, I would justify going maybe a little bit narrower. Oh man, one tick made a big difference. So one tick lower at 19, and now the target's at 27.50, and that gets you ahead of all of these high closes and opens, and it ensures that you're at least getting filled ahead of all of that. There's a lot of resistance there, so I don't want to try to press through that. So that tells us the optimal entry point is going to be at 19 or better. And the bottom of the wedge is right there at 18.50. So everything lines up in terms of an optimized entry point right around 19 to continue the market back up. Now, it did end up being to the tick high initially. It broke out a little bit later, but that's the reason. It's no coincidence that the market stopped dead in its tracks right there. Buyers wanted to buy it, but they knew that they couldn't buy it at the top of the zone that they would normally want to do so. And because of that, they modified their entry point so their risk made sense. Risk, reward, and probability all lining up. That's how you know you've got a winning solution to the question at hand, which is the market going to go up? In this case, yes. And by optimizing your entry, it allowed a way out to the tick, albeit, so I know how my luck goes, I wouldn't have been filled. But at least it tested it, right? It's better than leaving it alone, came all the way back, and then eventually did work. But that's the whole difference. A couple ticks. There was only a 1 tick difference in entry, but it made all the difference in terms of targets. And that is sometimes all it takes when you're talking about the S&P. So hopefully you find that useful, interesting, entertaining, and something to keep in mind when you're looking at your next entry point. Does it fit with what I'm expecting to see here? And if it doesn't, maybe a little bit of entry optimization is necessary. Something to keep in mind. That's going to do it though. Like we always say, stay safe out there, keep those stops in play, let the winners run. Until the next one, we'll talk to y'all later. Thanks.